Usually, when you analyze commercial real estate data, it feels like watching a massive cargo ship slowly turn in the open ocean.
Right. It takes quarters or even years to actually see a shift.
Exactly. Shifts take forever. But if you look at what's happening right now in the Coeur d'Alene, that's Coeur d'Alene multifamily market, it looks less like a ship turning and honestly a lot more like a roller coaster dropping.
Oh, absolutely. It's wild.
Because just 2 years ago, the apartment vacancy rate there spiked to this massive
Yeah.
16.1%.
Yeah, a huge peak.
And today, the Q2 2026 data shows it has plummeted all the way down to 6.8%.
It is a breathtaking recovery, honestly. It proves that this market has finally digested a really historic waves of new apartment supply.
Right.
But here is the catch. Even though those buildings are filling up fast, the actual buying and selling of these properties is completely frozen.
And that brings us to today's topic. Welcome to today's deep dive. We are unpacking the Q2 2026 CDA Multifamily Market Report. And this is brought to you by Activate Real Estate.
Happy to be here to break it down with you.
Yeah, we are going to figure out how a market with skyrocketing tenant demand can simultaneously have, well, practically zero transactions.
It's quite the paradox.
It really is. And just for context, all the figures we're citing today are pulled directly from the Q2 2026 CoStar Market Report, paired with the external context brief prepared internally by Activate Real Estate.
That's right.
And we promise to unpack all of this for you, making sense of the mechanics behind the numbers in under 20 minutes.
We've got a lot of ground to cover.
We do. And a quick note right at the top, if you have questions as we go, or if you need a custom market breakdown for your specific properties, you really should reach out to Eric Peterson directly at 509-903-9077.
Definitely. He's the guy to talk to.
So let's establish our baseline first. Can you give us a rapid-fire summary of the quarter?
Sure, let's do the quarter in a minute. Here are the major headlines you need to know from Q2. First, on the demand and supply side, vacancy is tightening rapidly at that 6.8% mark.
Wow. Okay.
Yeah. And meanwhile, new construction has practically vanished off the map. There are only 225 units currently underway in the entire market.
That's practically nothing for a growing area. And because those units are filling up, asking rents are growing again, right?
Exactly. They're hitting an average of $1,619 a month. But meanwhile, in the capital markets, the Federal Reserve remains super hawkish.
Right. They're not backing down.
No, they're keeping the 10-year Treasury elevated at 4.49%. So if you remember only one thing from this deep dive, make it this. CDA tenant demand is winning the battle against the recent supply wave, but capital markets are keeping buyers and sellers trapped in an absolute standoff.
Trapped in a standoff. I like that phrase.
Yeah.
We have this frozen transaction market today, but, we can't just stare at the current gridlock.
No, you have to look at how we got here.
Right. To understand why no one is buying or selling, we first have to look at what just happened to the physical supply of apartments.
Yeah, the building boom.
Exactly. Between 2022 and 2024, developers delivered thousands of new units to the market. It was actually the largest supply wave since the 1980s.
It was massive.
They basically, they set a massive, heavy Thanksgiving turkey dinner on the table and forced the local market to eat it all at once.
That is a perfect analogy. And the market predictably got the meat sweats.
Right.
Vacancy peaked at that staggering 16.1% in the fourth quarter of 2024. The area simply could not absorb that many units overnight.
It's just too much volume.
Exactly. Developers who had secured cheap financing during the pandemic, well, they all delivered their projects at the exact same time.
But looking at this Q2 data, the local economy apparently has a phenomenal metabolism.
It really does.
Because that vacancy rate has compressed back down to 6.8%. And to put that in perspective for you, the national vacancy average right now is 7.2%.
Yeah, so the local market is actually beating the national average.
That's incredible.
It is. Year-to-date absorption is incredibly positive, with 160 units absorbed. And because the oversupply has been, eaten up, landlords have pricing power again.
Because they aren't desperate for tenants anymore.
Exactly. Asking rent growth is back in positive territory at 1.9%. For a property manager on the ground, this means they're spending less on marketing.
Oh, that makes sense.
And they are burning off those crazy concessions, like offering 2 months of free rent just to get someone in the door. So their revenue is finally stabilizing.
Okay, wait. Let me look at this from a property owner's perspective for a second.
Sure.
The units are filling up. The concessions are burning off. The rent is being paid. Basically, the operational indigestion is over.
Operationally, yes. Things look great.
So why are owners still feeling the pain?
Because while the buildings are performing beautifully on an operational level, the debt on those buildings is a completely different story.
Oh, the loans.
Right. The
Yeah.
financial indigestion is still burning hot. But before we diagnose the debt problem, we really have to look at the revenue side first.
Okay, let's do it.
Like, who is actually paying that $1,618 a month in rent? You can't fill thousands of apartments without human beings.
Right. It comes down to raw population growth, doesn't it?
It does. The CDA Metropolitan Statistical Area, which is essentially Kootenai County, spelled Kootenai, pronounced Cootani, has grown by 11% since 2020.
11% in just 6 years. That's huge.
Yeah, they're at about 195,000 people now, adding roughly 300 to 500 new residents year over year.
Wow. And an 11% jump far outpaces the national average, which is, what, 3.7% over that same period?
Oh, exactly. It's massive growth.
And that is driven mostly by domestic immigration, right? People moving from other states, maybe leaving places like Spokane or Seattle to come over the border.
Yes, exactly. And the jobs are following those people. Healthcare is a massive driver right now.
Oh, right, the new facilities.
Yeah, you have the 30-acre Prairie Medical Campus expansion in Post Falls, and that's creating high-quality, high-paying jobs. Education is booming, too, with North Idaho College posting double-digit enrollment growth.
Okay, let me stop you there, because something doesn't add up for me.
What's that?
Population growth and job growth are great. But, these people with solid careers in healthcare and education,
Right.
why are they renting apartments? Why aren't they just buying houses with white picket fences?
That is the ownership affordability gap, slamming the door shut.
The affordability gap.
Let's look at the mechanics of the local housing market. The median single-family home in Kootenai County is now sitting between $552,000 and $620,000.
Wow.
Yeah. For sale prices have rocketed up a staggering 181% since 2015.
181%. That outpaces local wage growth by a mile.
By a country mile. Now, pair that $500,000 price tag with today's 30-year fixed mortgage, which is sitting around 6.43%.
That's a painful combination.
It is. Let's run a hypothetical scenario. Say a nurse at that new Prairie Medical Campus wants to buy a $600,000 home.
Okay.
Even with a 20% down payment, which is $120,000 in cash, mind you.
Which is really hard to save up.
Exactly. Even with that, their monthly payment with taxes and insurance is going to hover around $4,000.
$4,000 a month, which is entirely out of reach for a massive segment of the workforce.
Completely out of reach.
So would-be buyers are effectively trapped in the renter pool. They're earning good money, but not enough to clear the hurdle of a 6.5% mortgage on a $600,000 house.
You nailed it.
So they rent Class A luxury apartments for $1,600 instead.
That structural lock-in perfectly explains why the vacancy rate plummeted back down to 6.8%. The demand is not going anywhere.
Okay, but if you're listening to this right now and you own an older Class B or Class C property in CDA, you might be thinking, this doesn't apply to me. I didn't build those luxury units.
Sure, that's a common thought.
How does this Class A supply wave affect the older buildings down the street?
It's all connected through the concept of filtering.
Filtering.
Yeah. When there's a flood of new Class A supply, some renters upgrade to the shiny new buildings, leaving vacancies in Class B buildings.
Ah, I see.
So then, landlords in those older buildings have to offer concessions to compete and fill those gaps.
Right.
But now that the new supply has been digested, that downward pressure is gone. Rents across the entire spectrum, from luxury to workforce housing, are stabilizing.
So the tenant demand is totally locked in. But this brings us right back to the financial indigestion we talked about earlier.
The debt side.
Yeah. If local families are struggling with a 6.4% residential mortgage, how are commercial property owners handling their own debt?
It is the defining challenge of the quarter, without a doubt.
Let's dig into that.
Let's look at the macro capital markets snapshot. In June 2026, the Federal Reserve held the federal funds rate steady at 3.50 to 3.75%. It was a hawkish hold.
Meaning they kept rates flat, but aggressively signaled they're not done fighting inflation.
Exactly. The median dot plot, which is essentially where the Fed officials collectively project rates will go, actually rose to 3.8% for the end of 2026.
Oh, wow.
But for commercial real estate, the Fed funds rate isn't even the most important metric. Lenders look at the 10-year Treasury because it serves as the risk-free benchmark for long-term commercial debt.
And where's that sitting?
That closed the quarter elevated at 4.49%.
And meanwhile, the one-month SOFR is near 4.14%.
Hold on. For those not staring at bond yields all day, What exactly is the SOFR?
Good question. SOFR stands for the Secured Overnight Financing Rate. It's essentially the baseline rate that banks use to figure out how much to charge you for a variable rate or floating rate loan.
Okay, so it affects floating rates.
Yeah, so when SOFR is high, anyone with a floating rate mortgage is feeling immediate pain every single month. Their payments go up as the rate goes up.
Ouch. So if I am an owner looking for a loan right now, what does this environment actually look like for me?
Well, agency lenders like Fannie Mae and Freddie Mac are absolutely active and willing to lend. Debt is available, but it is painfully expensive.
Right. The biggest issue facing the market is the looming refinancing wall. Let's walk through another scenario to make it real.
Let's do it.
Imagine you bought a 50-unit building back in 2021 for $10 million.
Okay.
Back then, rates were near zero, so you locked in a 3.5% interest rate on a 5-year loan. Your monthly mortgage was totally manageable.
And now, in 2026, that loan is maturing.
Exactly, which means you are forced to refinance in a market where rates are 200 to 300 basis points higher.
Which is a massive jump.
It is.
Yeah.
To refinance at 6.5%, your payment jumps massively. But your rent revenue, your net operating income, well, it only went up by a fraction of that over the last 5 years.
Right. And lenders look at something called the debt service coverage ratio to see if a building makes enough money to pay its mortgage, right?
Yes.
The formula is just your net operating income divided by your debt service.
Correct.
If your income doesn't safely clear that higher monthly payment, the bank just won't give you the loan. You're stuck. Lenders are underwriting deals to today's rates, not the cuts everyone was hoping for 6 months ago.
Exactly. And this expensive debt leads directly to the deep freeze in the transaction market.
It's a standoff.
Right. The Q2 2026 CoStar data reveals some genuinely chilling numbers. Sales volume for the quarter is virtually non-existent.
How bad is it?
Year-to-date, transaction volume is hovering around a mere $2 million.
$2 million for an entire metropolitan market.
Barely $2 million.
That is a rounding error. I mean, compare that to 2025, when year-to-date volume was at 15.7 million, and even that was subdued compared to historical averages. The market is completely stalled.
It really is. Market cap rates are sitting at 6.2%, and the transaction cap rates for those very few closed deals are at 6.1%.
Yep.
Overall valuations are hovering between $157,000 and $163,000 per unit.
Wait, you're saying no one is selling because of high interest rates?
Right.
But if buyers cannot afford to borrow money at 6.5%, shouldn't sellers just lower their asking prices until the math works? Why aren't we seeing a massive drop in property values to bridge that gap?
Because of human psychology, honestly, and the reality of equity.
What do you mean?
Sellers who locked in 3.5% debt are sitting on cash-flowing properties. If they lower their asking price to meet today's expensive buyer math, they wipe out their own equity.
They take a huge loss.
Right. They would rather hold the property and collect the rent than take a massive loss on a sale. Unless a seller is forced to sell by a maturing loan, that refinancing wall we talked about, they are simply refusing to trade.
And for the buyers, the math is just as brutal. Let's look at negative leverage.
Yeah, negative leverage is key here.
If I'm a buyer and the property is generating a cap rate of 6.1%, but I have to go out and get a commercial loan at 6.5 or 7%, I am losing money on the debt.
You're in the red on day one.
It's like buying a mutual fund that pays you a 6% dividend, but taking out a 7% credit card loan to buy it. Every single month, the asset pays you, but you're still losing money on the spread.
That perfectly explains why transaction volume has flatlined. Why would a rational investor buy a property that bleeds cash on day one just to service the debt?
They wouldn't.
Right. Unless you're buying all cash or you have a massive value add plan to instantly spike the net operating income, the math simply does not work.
Which also explains the buyer profile right now. When deals do happen, they are 100% driven by private investors. Institutional capital is entirely absent from this market.
That's right. Institutional funds have strict quarterly return mandates. They cannot justify negative leverage to their shareholders.
But a private investor can.
Private investors, on the other hand, might be executing a 1031 exchange to defer taxes or maybe parking generational wealth for the next 20 years.
They have a totally different timeline.
Exactly. They have longer time horizons and are less sensitive to short-term interest rate pain.
Okay, so the ripple effects of this negative leverage go far beyond just buying and selling existing buildings.
Yeah.
It also dictates what gets built, doesn't it?
Oh, absolutely.
Because if investors aren't buying existing buildings, are they at least building new ones to meet that 11% population growth?
The short answer is no. Looking at the multifamily specific construction pipeline data, it has completely collapsed.
Collapsed.
Yeah, there are only 225 units currently under construction in the entire CDA market.
Let that sink in for a second. During the peak in 2022, developers delivered over 1,400 units in a single year.
Yeah.
And now, construction starts have effectively fallen off a cliff.
The pipeline is draining rapidly, and multifamily construction takes years from securing permits to pouring concrete to framing and finally leasing up.
It's not a quick process.
Not at all. So a dead pipeline today means no new units opening their doors in 2027 or 2028.
Wow. And it's worth noting here that Activate Real Estate has cross-referenced these CoStar market benchmarks against their own internal portfolio data.
Yes, and the alignment is absolute. Yeah, the internal portfolio occupancy and effective rent trends at Activate Real Estate mirror these tightening market conditions perfectly. The operational data tells the exact same story across Kootenai County.
Which is what exactly?
Units are staying full, rents are stabilizing, and new supply is simply vanishing.
So we've established that the operational side of the market is very healthy, but the capital markets are completely frozen.
That's the paradox.
As we move into Q3 2026 and beyond, what is the first domino that falls? What should you, as a listener, be watching closely?
There are three main forward watch items. First is employment volatility, specifically in tourism and hospitality.
Why that sector?
Because that sector is a major swing factor for the local CDA economy. If consumer spending tightens nationally, you might see a pullback in resort and hospitality hiring.
Which directly impacts the renter base.
Exactly. Keep an eye on the macroeconomic weather, essentially.
Got it. What is number two?
The refinancing wall. As we discussed, a significant number of owners who bought or refinanced between 2020 and 2022 are facing loan maturities right now.
And if they can't refinance?
If they cannot meet the required debt service coverage ratio at today's 6.5% rates, they may be forced to sell at a discount. That could finally thaw the frozen transaction market, but it will be driven by distress rather than opportunity.
That's a painful way to thaw the market. And the third item?
The third item is the absolute lack of new supply deliveries. That 225-unit pipeline is a flashing red signal for the future of housing availability in the region.
Which creates a massive tension point for the future.
It really does.
And that actually leads me to a final, slightly provocative thought I want to leave you with today.
Let's hear it.
We know population growth is continuing. People are still moving to North Idaho. We know single-family homes are entirely unaffordable for the average worker, effectively trapping them in the renter pool.
Right.
And we just learned that new apartment construction has ground to a complete halt.
So the supply and demand imbalance is widening every single day.
Exactly. So what happens to CDA rental rates in 24 months when the current supply is completely 100% gone and there are no new buildings opening their doors?
It's going to be intense.
We might be looking at a massive pressure cooker for rent spikes. The market digested the massive Thanksgiving dinner, and pretty soon, well, the fridge is going to be completely empty.
That is a scenario that owners and investors really need to be modeling for right now.
Absolutely. The operational upside could be significant, provided you can navigate the debt side of the equation.
Navigating the debt is everything right now.
And navigating a market this complex, where operations are fundamentally strong, but the capital markets are frozen solid, it requires real expertise. You don't want to fly blind through a refinancing wall.
No, definitely not.
And you definitely want to be positioned to capture the upside of that tightening supply. Make sure you reach out to Eric Peterson at Activate Real Estate.
Give him a call.
You can call him at 509-903-9077 to discuss exactly how these numbers impact your specific portfolio and strategy. Thanks for taking the deep dive with us today. Keep your eyes on that pipeline, and we will catch you on the next one.